Hello, continue the series on section E of the syllabus, which is on business finance. The previous video we said asset can be financed either by debt, which is liability, or equity, or you use the both. Right. Now, we've been looking at the sources of finance, sources of capital, and we agree that we only have two. Yeah, is that you use this one or use this one or use both of them? Yeah. But very important note and a reminder that asset is a combination of non-current asset and current asset. Likewise, this liability is a combination of non-current liability and current liability. Right, you have the equity standing there. It's always a long time and so on. So I'm trying to do a quick reminder for you. So current asset and current liabilities, those are the working capital which we have dealt with under section C of the syllabus. We've dealt with this one, and now we're focusing on financing this non-current asset using either we use the debt, long-term debt, or we use the equity, or we can use two of them. Now, today we're starting with equity. Yeah, I've explained what equity is to you. I've explained what debt is to you. But now, today we want to look at cost of capital. And cost of capital, as you know, capital can either be equity or debt. So we want to start with cost of equity for this video. This video will look at cost of equity. That is what we want to look at today. So if you want to know the cost of equity, there are two models, two ways of doing this. And it's very important because I always tell you, why do we need to do this? If you don't know the cost of your equity, then you don't know how much your investors are expected for you to actually give them in order for them to get satisfied. So it's good you know what it's going to cost you. If it's going to cost you so much, then you'll be asking yourself, if you take it, can you put it in an investment that will give you so much more? If there's no investment that will give you so much more, then it's not worth taking more money from the equity holders, right? Or you might also ask yourself, if it's taking you so much, how much will it take you to use debt? So you want to check which one is cheaper. Then if the other one is cheaper, then you go for the other one. But most importantly, the major reason why you need to know the cost of your capital is for you to be able to choose the right investment for you. Because to make so much money, you need a lot of money to invest as well. So you always have to either get money from equity holders or from the debt providers, and it will not come at a free of charge. You will need to pay some money. There's a cost attached to it. So when you know the cost attached to it, then you can compare with the return that has been promised from that investment. So you can decide if it's a good investment or not. If the cost of a fund is more than the return, then it's a bad investment. But if the return on the investment is higher than the cost, then it's a very good investment. So that is why you always have to calculate cost of capital. So now you will learn how to calculate cost of equity, and I'm going to teach you how to calculate cost of debt as well. So now we are looking at cost of equity. And remember I said there are two methods of doing this. The first method is the dividend model. And the second method is a capital asset pricing model. I will call it CAPM, capital asset pricing model. Those are the two methods you normally have to use to determine your cost of equity. But I will start from dividend model first before we go into the capital asset pricing model. So let's start with the first model, which is the dividend model. This approach is used when you need dividend information. So this is for companies that you know regularly pays dividend. So you need dividend information to be able to use this approach. And using this approach, your focus is how do I use the dividend information that I have to determine the cost of equity. This can be also looked into two dimensions. The first dimension is when you have a company that pays constant amount of dividend every year and forever. Yeah, constant amount of dividend. So if you have company with a constant dividend policy, they say every year we're only going to pay $0.5 per share, and that is what they pay every year. It does not change, it does not reduce, it does not increase. They will never pay zero, whether they make profit or not. They are constantly paying $0.5 per share. That's a constant amount of dividend. And if you have such a company, you will use what we call the perpetuity formula. I'm sure you probably have heard of that. Perpetuity means forever. Yeah, perpetuity formula. This is a popular formula in finance space. And what this formula means is just saying that the value of such series of fund, right, that is being paid every year, that constant fund that is paid every year. So the value of that fund is equals to that constant cash flow divided by the rate of return. I will explain this for you very well. Yeah. So the value of the constant, this is the constant cash flow that is being paid to perpetuity forever, right? You divide by the rate of return, and that will give you the present value of that kind of cash flow. Because someone can ask you, take for instance, if you have a car that you know that this car can be used, maybe let me not use a car because you can't drive a car forever. Let's use a business. You have a company, and this company says they will give you $10,000 every year forever till eternity. Value of that company to you is that 10,000 that has been promised divided by the rate of return you are asking for. If you're asking for 8%, yeah, and that will be the value of that company. So it's just 10,000 divided by 8% that gives you the value of that company. That is how perpetuity formula is being used. Now, how can we use it for this cost of equity that we are talking about? Now, I need to explain to you this rate of return because this is another area where I think students get stressed up. This rate of return. So rate of return, anytime you are dealing with cost of capital, rate of return is the same thing as your cost of capital. Please take note. And I will explain why. I think I alluded to this in my previous video. Rate of return is what investors, the fund provider, so this is what fund providers are requesting for as return. That is what rate of return is all about. If I'm giving you my money, either as equity holder or as a debt holder, I'll be asking you to pay me something. Whatever I'm asking you to pay me is the return I require. So that is my rate of return required. And so this is for the investors' perspectives. And for the company that is using the money, it's a cost. So this is company's perspective, but it's the same figure. So the cost to company is returned to the investors. So investors are giving money to the company and asking for 8%. That is the required return they are asking for. And for company, they are paying 8% to the investors. That is the cost of capital to the company. So take note, rate of return is the same thing as cost of capital because in questions, they will give you all the parameters and they ask you calculate the required rate of return. It's the same thing as calculating cost of capital. Please take note. Right. So in this formula, we're just going to substitute rate of return for cost of equity. So which means the value we are talking about is just equals to that cash flow divided by cost of equity. So our KE is cost of equity. Take note. Yeah. And the cash flow we are talking about here, yeah, is the dividend per year, the annual dividend. So which means the value of the share that we are referring to is the price of the share. So this same formula of perpetuity that I just mentioned can now be rewritten to say the price of the share, usually compulsorily, please take note, asked to be X price, I will explain what that means, is equals to the dividend, the constant dividend that has been paid per annum, divided by the cost of equity. So if you rearrange this formula, because what we want to calculate is cost of equity, is equals to dividend per year divided by the ex-div price. That's the formula for cost of equity when the dividend is constant and it's being paid every year till eternity. Ex-div price, I need to explain what that means to you because it's extremely important. You must always use ex-div price, and this is price of share after dividend has been paid. So the price you will use must always be the price of that share after the dividend has been paid because there is a cum dividend price as well. There can be cum dividend price, and this is the opposite. This is when dividend hasn't been paid. Please take note. But this is what we use for calculation. We don't use this. So if the question gives you cum dividend price, say $8 per share, and the question says dividend of $0.5 per share is about, so that's another tricky way to put the question, is about to be paid. Then you know that you must determine your ex-div price. You can't use this cum div price for your calculation. So you need to calculate your ex-div price, and that will be equals to $8 minus 0.5. So you are going to use ex-div price of 7.5 for calculation. Please take note. Always use ex-div price. Extremely important. Not cum div price. Very important. Right. So this is the formula for cost of equity when dividend is constant. Very important. You must take note of that. Yeah. So if I give just a quick example, let's say you have a company. So you have company here, yeah, with X div share price of let's say $2 with annual dividend. Yeah, let's say they pay annual dividend. With annual dividend of $0.5 per share, right? No dividend growth is expected. So what this means is that this company is not planning to pay any dividend more than what it has been paying on annual basis. And this is asking you to calculate cost of equity. What is the cost of equity? Cost of equity, remember, is just your annual dividend divided by the ex-div price. And annual dividend is 0.5. Ex-div price is $2. So multiply by 100%. What would that give us? This will give us, I think that's 25%. Super easy, isn't it? So it's as easy as that. If the constant dividend is given and you don't expect the dividend to change, the question is going to tell you that it's a constant dividend that will be paid, no growth, no change in dividend is expected, then it's just a simple formula you have to use. And that's how you get your cost of equity. That is one dividend policy, A. There's this second type of dividend when dividend is not constant, and that is when you have a growing dividend. So those are the two ways you can be tested under dividend model. Yeah, so when you have a growing dividend, so which means there's a growth rate which you will need for this one because dividend is growing, dividend is not constant. So in your financial management paper, is that you have a constant dividend or you have a growing dividend, and dividend is assumed to be growing at a constant rate. Please take note. The growth rate does not change. Yeah, that's the assumption. Growth rate is always constant. So what we did before was constant amount, but what we are doing in B is a constant growth rate. So dividend is not constant, it's a growth rate that is constant. And in this case, the cost of equity formula is slightly different because it's not going to be dividend over price as we had it before, but now growth rate will be considered, and in that case this dividend will be grown by 1 plus g, and you add another plus g to it, right? So this is the formula. It's different. You can see we added this part and this part to it, so that makes it slightly different from the one we had before. Before, there is no 1 plus g, and there is no this plus g because there is no g. If you make g 0 in this formula, look at it. If you say g is equals to 0, which means a constant growth rate, I mean, so constant amount, there is no uh, growing concentration here. And if g is equals to 0, that formula can easily turn to this. Look at it. It becomes d into 1 plus 0 over p naught plus 0, and this automatically will give you d over p naught. So that's why this is your formula when the dividend is constant dividend amount. But when the dividend is not constant, when dividend is expected to grow, then becomes d over p naught, then it's going to grow. This will multiply by 1 plus g, and the whole formula will be added to g. So this is your cost of equity when g is expected to be involved. All right. So, and we can just do a question quickly on that. So I'm still going to work a typical full exam question on all of this, but I'm just going to give you just a snippet of questions just to see how the formula is being applied, and from there on, uh, we can move on to a full-blown exam question. So let's assume you have company A, right, has a share price of $4, ex-div, to make life easy for you. Yeah, dividend paid, let's say 20 cents. Yeah, so if they pay 20-cent dividend, and let's say the growth rate of dividend, so dividend growth rate is also going to be given. Dividend growth rate, sometimes you have to calculate the growth rate, but I'm going to teach you how to calculate that as well. So but for this question, let's stick to dividend growth rate of 5%. Now you are being asked to calculate cost of equity. So now you know G, this is G, this is dividend, and this is price. And we're going to apply this formula. Yeah, so cost of equity equals to D into bracket 1 plus G divided by P naught plus G. Yeah, so I mean cost of equity equals to our D is 20 cents, which is 0.2. G is 5%, so 1 plus 5%. The brackets, price is 4, then plus 5%. Right? Easy. So if you work all of this, you're going to have cost of equity of 10.25%. 10.25%. Another tricky way they can ask the same similar question for especially for growing dividend. Please pay attention to this, extremely important. Sometimes they say that dividend expected to be paid. That's what they will give you. They will say dividend expected to be paid in the following year. They say dividend that is expected to be paid in the following year is, say, 0.3. They will still give you growth rate, right? Let's say the growth rate is still 5%, whatever it is. If they give you these figures and they don't give you the current dividend, please take note that this numerator, this topmost part of the formula, this part, D into 1 plus G, means that you have grown this dividend by 1 year. So in this case, if this question says this and G is still equals to 5% and price is equals to $4, then this same formula that we're saying D equals to D naught, D naught is the current dividend paid in the current year, right? 1 plus G over P naught plus G. But now this question that I'm giving you has not provided the current dividend paid, but has only given the dividend to be paid in the following year. So what this means is that D naught into 1 plus G, please take note, is the same thing as dividend to be paid in the following year. So next year. In fact, another way to call it is the same thing as D1. You can call it D1. So D naught, D0 is now, dividend paid now. D1 is dividend that will paid next year. So this same formula can be written as, the growing dividend formula can be written as same as D1 over P naught plus G. And what it means is that D1 is the same thing as D naught into 1 plus G. So if you apply that formula in the question, it means that KE will equals to 0.3, because we said the dividend to be paid in the following year is 0.3, right? So that means that's 0.3 divided by 4 plus 5%. I hope I've not done any magic. Just pause for you to absorb that. Right. So what I'm saying is D1 just means the dividend to be paid in the following year, and that is the same thing as D naught into bracket 1 plus G. Yeah. And you're still gonna have your 12.5%. So when you have a question like this, take note, and they give you a formula, and they give you a dividend for the following year. You don't grow that dividend again, and you don't use 1 plus G. It's just D1 that they have given you, and take note the way you apply the formula. Now let's learn how to calculate G. So now you know that for dividend model, for cost of equity, you can either be given a constant amount of dividend, which you use perpetuity formula, or you can be given a constant growing dividend, which means they will give you G, yeah, and D not. Or sometimes they will give you D1. But here you only have D that will be paid every year to eternity. Now let's learn how to calculate G, growth rate. Yeah, growth rate. We want to learn how to calculate growth rate. Interestingly, there are always two ways almost to everything. See where we're coming from. Sources of capital, two sources, equity, debt. Now we're looking at cost of capital. We want to look at cost of equity. We said there are two models for cost of equity. There is dividend model and there is capital asset pricing model. Now we started with dividend model. For dividend model, we said dividend can be in two ways. Either is a constant amount of dividend or is a dividend that is growing at a constant growth rate, and we have dealt with that. Now we want to calculate we want to determine how to estimate our growth rate. And we say there are also two ways of determining the growth rate. The first method is the average method. All of these are extremely examinable. The second approach is the Gordon. Gordon is someone's name. Gordon's growth rate. Yeah, let me call it Gordon growth model. Yeah. Let's deal with average method first. Average method leverages on this formula. Very popular formula in finance management. It's called the compounding formula. You ever heard of compounding formula? Right? Some people call it compounding formula. Some people call it future value formula. It's the same thing, and I'll write the formula now. Yeah, yeah. You call it this, and the formula is just saying, and the future value of a cash flow is equal to the present value of that cash flow, open the bracket, 1 plus the rate of growth of that cash flow raised to the number of years that you want to grow the cash flow. This is a very popular formula. Yeah, you cannot do financial management without knowing this formula. You will see it in many places, especially when we get to investment appraisal. We're going to learn a lot about this formula. But look at this formula. Yeah, it's a compounding formula or future value formula, or some people even call it present value formula. So you can see this is present value also there. This is future value here. But this is the formula that was actually used to determine growth rate. And what they are saying is that this R that we're talking about is the same thing as the growth rate, which is this is the parameter we need to resolve. So if you rearrange this formula, which I can quickly show you, so this becomes 1 plus R raised to power n equals to future value divided by present value. Now, to calculate R, you need to find nth roots in mathematics, right? So 1 plus R will be equals to nth roots of future value divided by present value. And R is equals to nth root of future value divided by present value minus 1. So this is it. And R is your growth rate of dividend, so which is equals to nth root. N is the number of years. Future value is just your most recent dividend. Yeah, most recent dividend, which I will call dividend 1 divided by the oldest dividend. I'll call dividend naught minus 1. This is the first method, the first approach to calculating growth rate. So take for instance, if you have company A, yeah, that paid a dividend, say of 20 cents, like we said before, 4 years ago. Yeah, let's say the current dividend is 33 cents. Yeah. And the share price is $6. Ex-div. I say calculate the cost of equity. Calculate the cost of equity. Definitely. You need growth rate to be able to calculate cost of equity because this question has not given you a constant amount of dividend. You can see 4 years ago, 20 cents of dividend was paid. Then currently this year, 33 cents has been paid. So the dividend amount is not constant. So which means you need to use the second formula. And the second formula for cost of equity says that the current dividend growth by 1 plus G divided by price plus G. Now we know D naught, which is 33. Yeah, this is our D naught. Yeah, so we know that this is our D naught. We know our P naught as well, but we don't know G. So, but what we can see is we can see that we have a very old dividend here that was paid 4 years ago, 40 cents, 20 cents. And we have the latest dividend of 33. So we can actually use this approach to determine our growth rate. So which means our growth rate will be equals to n is number of years. How many years ago? That was 4 years ago. So fourth root of the most recent dividend. And what's our most recent dividend? That is 33 cents. And the oldest dividend is 20 cents minus 1. Yeah. If you put that another way, if you want to do it on Excel, you can do G equals to 33 over 20. All of these raised to power 1 over 4. Yeah. Then minus 1. If you put all of that in Excel, we have G that is equals to 13.3%. So if G is 13.3%, then we can now put G in this formula. Yeah, here. We can put G in this formula. Then we know that our cost of equity will be equals to the 0.33 current dividend 1 plus 13%, which is the G, divided by the price of share. The price is $6 we're given, and plus 13%. Yeah, all of that will give us cost of equity of the calculator. That will give us 19.56%. And that's cost of equity. Here you've not seen how to calculate growth using the average method. Now the second method is the Gordon growth model. So you can also use Gordon to calculate, and this is pretty simple. What this is just saying, Gordon is saying that the growth rate is simply equals to RB, and R is pretty easy. It's just your return rate, and B is retention rate. Yeah, return rate is return on investment. Yeah, you will be given return on investment. And retention rate is, so your retention rate is the percentage of profit not paid out as dividend. Take note. That is the retention rate. So if a company, so company A that pays 20% of profit as dividend, what would be the retention rate? If this is 20% payout, then retention rate for this company will be 80%, because if it pays out 20%, you'll be left with 80%. So the percentage that is not paid out is your retention rate. So another way to say it is to say that retention rate, which is B, is equals to 1 minus payout percentage. Yeah. So That's another method of calculating your growth rate. And once you calculate the growth rate, then you can come and apply the formula of cost of equity that needs the use of G. Yeah, when dividend is always growing. And that is it for dividend model. Yeah.